No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning and welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking about the markets today, and we're also going to be talking about how those markets are going to affect, of course, your 401ks, your retirement accounts. We're going to get into retirement accounts quite a bit, talk about the risks associated with retirement in general and even pre-retirement, leading up to retirement, some of these same risks, market risk being one, inflation, of course. Interest rate risks. There are a number of risks out there that can affect us as we're preparing for retirement, as we're heading into retirement, of course, as we're in retirement. And some of these risks are in particular important when you're leading up to and in retirement that are going to be consistent. In other words, market risk is one of those. So with market risk, we're concerned leading up to that that we might lose money in the stock market. Understanding how important it is for asset allocation, your modeling and diversification. So an example of that would mean if you own, say, 4, 5, 6 different stocks, that's not being diversified, okay? Even 8 or 10 stocks is not being diversified. And even those might be in different sectors, it's a lot more risk. And an example of that would be, let's say the S&P 500 index. Now, the S&P last year ended up almost 29% for the year. An excellent, fantastic year. Right? Even saying that though, and by the way, 90% of all the companies in the S&P 500 ended up for the year of differing degrees. Not all of them, hit as well. Some exceeded the 29, some didn't do as well. And there were about 10% of the companies, and this is the cautionary part, about 10% of the companies in the S&P 500 index, even with a finish like that for the market, ended up down for the year. And this is the risk of not being diversified. If I just happen to pick the companies of those 50 companies that were down for 2019, then and not only miss out on those potential gains of owning all 500 companies as an example, and because it's so difficult to know which companies to go with, did I do as well as, and the risk factor of volatility, all right? Not only might a company go out of business and I might lose my money completely, right? But there's also the volatility of it just dropping. I've got a loser in a year, okay, a losing portfolio in a year when the market does so well. And that sets me up for long-term consequences with regard to my portfolio as well. And your portfolio, of course, is the financial engine that drives your retirement. That's how you're going to have that income is going to be coming from that for most of us. And we're going to talk about that again. What sources of income are you going to have in retirement? How important are your portfolios and your retirement accounts going to be to you in retirement? And how can you, in fact, make sure that you're going to have the income that you need, that you're going to get the growth, that market return, but reducing volatility at the same time. All of that. And of course, in these retirement accounts, all the different rules. There's a lot of complexities that go in with retirement accounts, in particular when you start taking money out. We're going to talk about those and how you can, in fact, educate yourself. We're going to help you learn about these rules so that you can set yourself up for success in retirement. Now, again, S&P's up about 29% for 2019. Then we had a nice day yesterday in the market, the first trading day of the new year. And then today with the news out of Iran about the bombing there with taking out one of their top general actually, and the effects that's had on the market leading in. Now it started out looking a lot worse. It's recovered a little bit. We'll see how the day goes here with regard to the market. Now the Dow Jones, by the way, ended up last year at 22% up. NASDAQ 35% up. So you're seeing returns, gains, basically best years, if you will, since 2013. So in about 6-7 years. And then even unusual is that we also had commodities like gold and oil were also up. Gold was up 19% in 2019, which usually when you see the markets up, gold doesn't typically, since it's a defensive play, typically doesn't do as well, and in fact would normally even finish down. But that's the best year for gold since 2010, so almost 10 years now. Keep in mind too that the S&P and the markets were down in 2018. All right, so you had a down year of almost about 6%, and then followed by this up year of 29. What's on store? And of course, this is the big question, right? What's on store or in store for 2020? All right, what do we expect here? And the economic news still looks good. We do have geopolitical things, as we can see, that can affect that volatility. And of course, trade wars and the rest of it that will carry in. And it's an election year. Election years typically are going to be more volatile as well. So there's a lot of things in the mix here to come into play. Now, one of the things this year may not be, at least as far as the election, as volatile, and this is mainly because this is a year in which you've got an incumbent still up for re-election. So that would not bode, in terms of change, might look less likely, and that could be more stability for the markets. We'll see how this plays out. Now, one of the things to understand when it comes to preparing yourself is understanding the risk you're facing. Okay, so let's take a look at our first slide, different types of market risk, or excuse me, different types of retirement risk that you're going to be facing. One of those being, of course, market risk, which we're just talking a lot about the markets. So that volatility, the ups and downs, how you're invested can help you dramatically. In fact, your asset allocation, not recent, in fact, this has been known for many, many years, is the studies show us that asset allocation is the biggest determinant of not only what kind of return you're going to get, but also what type of risk or volatility you're going to deal with in down markets. So asset allocation is so important, and understanding not only how important it is when you're trying to put together a portfolio, but understanding the different pieces that can help you with that. So for instance, as I've mentioned many times, we've got 60 years of Nobel Prize winning academic research showing us how to construct a portfolio, how to utilize asset allocation to accomplish the goal of that market return, but with less volatility and risk. And we've talked, again, I got into times on the show, talked to you about blending together, for instance, large companies and small companies. This is from Nobel Prize winner Dr. Harry Markowitz. He's the father of modern portfolio theory. Followed up on that with Dr. Eugene Fama, who developed a three-factor model with regard to portfolios. And you see a way here that you can put these together. So large companies and small companies, growth companies and value companies. Understanding, of course, just blending together stocks and bonds on the macro side, how to do that and how to minimize risk in those bonds, which is another big one. Reduced duration. You don't want long duration bonds. You don't want high yield bonds. Those are going to be basically low credit junk bonds, basically. These are going to be companies and even government entities where there's a higher risk of default. So understanding how all these pieces work can help you with regard to minimizing market risk. There are other defensive strategies that can be utilized as well. Understanding momentum in the markets and how to take advantage of that is one of those. We'll get into that in more detail. Tax risk, this is another. How to minimize taxes. It's not just what you make, it's what you keep. If you want to keep more, you need to make sure you're paying attention to what kind of taxes you're paying and how to minimize those, and understanding strategies like the Roth IRA strategy. And this is especially coming in to be even more important with the passage of the new Secure Act this year. So that just at the end of the year, that got signed into law. Now starting in 2020, there's going to be some major changes. I talked about a little bit about this last week. We're going to get into it in more detail in coming weeks, and strategies to help you in that. So we're going to have Dr. Friday on. We'll talk about some of the tax implications there. We'll have Russ on because there's some pretty dramatic estate planning impact as well. All right. Death of a spouse. This is another risk in retirement that in particular, if you've got two incomes, if you've got pensions, if you've got Social Security, reducing down those income for that surviving spouse. What kind of plans do you have in place for that type of event? Inflation risk. This is one of the biggies, right? Even though it's been kept low right now and has for some years, that we'd still a factor even being low, and that's one of the reasons we invest in the market, is because we're looking to stay ahead of inflation, and most safe money options such as short-term fixed annuities and CDs, savings bonds, things like that just don't do it. So to overcome inflation risk, we're looking to protect our purchasing power on our dollars. Healthcare at risk, making sure that you've got a plan for covering healthcare costs. And then, of course, longevity is the Mac Daddy of them all. That's the one that is going to, in fact, magnify all the other risk. And I'm going to get into more about longevity and the importance of that in your planning. But first, we're going to take a break, and we'll get into other things regarding to markets and how to protect yourself, how to construct your portfolios, how to understand, in particular, the retirement accounts. So when you're blending together your retirement accounts, your 401k, 403b, TSP for you federal and military out there, and all your IRAs, all of that, understanding how the rules work as well as the market part. So we're going to get into that, but first we'll take a break. Join us here. We'll be right back on the Retirement Report.